Alex buys a rental property. David puts the same money into crypto. They both think they made the smarter choice. They're both wrong because one of them forgot to count the hours and the other forgot to count the zeros. And when you actually run the numbers over 20 years, the gap will make your stomach drop. Before we dive in, this video is for educational purposes only. Nothing here is financial advice. Always do your own research before making any investment decision. Let's keep this fair. Alex and David both have $60,000 saved. They both earn $65,000 a year. They're the same age, same city, same financial starting point. The only difference is what they do with that 60 grand. Alex uses it as a 20% down payment on a $300,000 rental property, a modest 3-bedroom house in a decent neighborhood. He takes out a 30-year mortgage at 7% interest. His monthly mortgage payment is about $1,595. He finds a tenant willing to pay $2,100 a month in rent. On paper, that's $505 a month in profit before he spent a single dollar on anything else. Alex feels like a genius. David takes the same $60,000 and puts it into crypto. Not gambling on random meme coins. He splits it strategically. $40,000 into Bitcoin, $15,000 into Ethereum, and $5,000 into a handful of established altcoins. He sets up an automatic monthly contribution of $400 and doesn't think about it again. His coworkers ask him what he's investing in. He says crypto. They laugh a little, nod politely, and change the subject. Nobody's impressed. On day one, Alex has a house, a tenant, and a story to tell at dinner parties. David has a hardware wallet, a confirmation email, and a price chart he's trying not to check every hour. It's not even close in terms of how it feels. But feelings and math are two very different things. For the first few years, Alex is living the landlord dream. Rent checks hit his account on the first of every month. He drives past his property on the way to work and thinks, I own that. He's claiming mortgage interest and depreciation on his taxes, shaving a couple thousand off his tax bill each year. He's building equity with every mortgage payment. He's watching comparable homes in the neighborhood tick up in value. Everything about this investment feels real, tangible, and smart. David, meanwhile, is on a completely different emotional roller coaster. In year one, his $60,000 in crypto shoots up to $90,000. He feels like a genius. Then in month 8, the market drops 40% and his portfolio crashes back to $54,000. He feels sick. Then by the end of year 2, Bitcoin starts climbing again and his portfolio recovers to $85,000. Then another dip. Then another recovery. David is not sleeping well, but he's not selling either. Alex's friends ask him about the property constantly. David's friends ask him if he's lost all his money yet. The social proof alone makes Alex feel like he's winning by a mile. Let's look at the real numbers through year 3. Alex has collected roughly $75,600 in rent. His mortgage payments total about $57,420. That leaves $18,180 in gross cash flow. Sounds great until you subtract everything else. Property taxes run about $3,500 a year. Insurance adds another $1,800. He's already replaced a water heater for $1,400, fixed a leaking roof for $3,200, and dealt with 1 month of vacancy between tenants that cost him $2,100 in lost rent plus $700 to clean and relist. Alex manages the property himself to save money, but that means phone calls at 10 p.m., weekend showings, and coordinating repairs on his lunch break. After all real costs, Alex's actual net cash flow over 3 years is somewhere around $2,500 to $5,000. Not the $18,180 that looked so good on paper. And that doesn't account for a single hour of his time. David, despite the volatility, has put in $60,000 plus $14,400 in monthly contributions. His crypto portfolio, riding Bitcoin and Ethereum's historical average growth cycles, is sitting at approximately $95,000 to $110,000 at the end of year 3. Some months it looked like $60,000. Some months it looked like $130,000. But the trend is up. He spent 0 hours managing anything, 0 phone calls, 0 emergencies, just a lot of deep breathing during dips. But Alex still has leverage working for him. His $300,000 property has appreciated roughly 3 to 4% a year and is now worth around $330,000 to $340,000. His equity has grown to roughly $70,000 to $80,000. That's real wealth built partly with the bank's money. That's the power of leverage, and it's the one advantage crypto investors simply cannot replicate. The rent check is the number everyone talks about. It's the number on the YouTube thumbnail, the number at the real estate meetup, the number your landlord buddy brags about at the barbecue. What nobody talks talks about is everything that comes out of that rent check before you actually keep any of it. Vacancy. The average rental property sits empty about 1 month per year. That's not a disaster, but it's a full mortgage payment with zero income to cover it. And when a tenant leaves, you're paying for cleaning, minor repairs, listing fees, and your own time to screen and show. Maintenance and repairs. The general rule is to budget 1 to 2% of the property's value per year for maintenance. On a $300,000 house, that's $3,000 to $6,000 annually. Some years it's a $300 faucet fix. Other years it's an $8,000 HVAC replacement you didn't see coming and can't postpone because it's August and your tenant is threatening to leave. Capital expenditures. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These are guaranteed future costs and they come in chunks of $6,000 to $18,000. If you're not setting aside money every month for these, you're not running a business. You're running on luck. Property management. If Alex hires a manager, that's 8 to 10% of monthly rent gone immediately. Roughly $168 to $210 a month. If he manages it himself, he's working a part-time job he's not getting paid for. Either way, it costs something. And then there's the one risk nobody likes to discuss. Bad tenants. A tenant who stops paying and knows the eviction process can cost you 3 to 6 months of lost rent plus legal fees. That single event can erase an entire year's profit or more. None of this shows up in the $505 a month cash flow number, but it shows up eventually. By year 5, Alex is deep in the reality of being a landlord. He's on his third tenant. He's replaced the roof for $9,500, dealt with a plumbing emergency that cost $1,600, and spent 1 month with the property empty between tenants. He's raised rent to $2,300, which helps, but his property taxes and insurance have gone up too. His actual cash on cash return, the money he actually pockets relative to the money he put in, is hovering around 3 to 5% after all real expenses. Not bad, but not the 15 to 20% return he told his friends about at the barbecue. David is still doing the same thing. Buying monthly, not selling, not panicking. Well, trying not to panic. By year 7, Bitcoin has gone through 2 more major cycles. Each cycle, the lows were higher than the last and the highs were significantly higher. David's portfolio, including his $400 monthly contributions, is sitting at approximately $180,000 to $220,000. Some of that is Bitcoin. Some is Ethereum, which has grown significantly as more developers built on its platform. His original $5,000 in altcoins either grew massively or got wiped out. That's the honest reality of altcoin investing. He didn't pick individual stocks. He didn't time the market perfectly. He just held Bitcoin and Ethereum through the chaos and kept contributing. The compound growth is starting to accelerate. The gains on his gains are now generating more new wealth each year than his original contributions. By year 10, Alex's property is worth roughly $400,000 to $420,000. His remaining mortgage balance is about $200,000. That puts his equity at approximately $200,000 to $220,000. Over 10 years, after subtracting every real cost, mortgage interest, taxes, insurance, repairs, vacancy, and capital expenditures, Alex's total out-of-pocket beyond the original down payment is somewhere between $25,000 and $40,000. David's crypto portfolio, with consistent $400 monthly contributions and Bitcoin and Ethereum's historical average performance across full market cycles, is sitting at approximately $200,000 to $280,000. He put in $60,000 up front plus $48,000 in contributions. $108,000 total invested. The rest is pure growth through market cycles. And he spent exactly 0 weekends fixing anything. At year 10, they are surprisingly close in total wealth. Alex might be slightly ahead thanks to leverage. But here is the thing. Alex also spent hundreds of hours managing his property, took on hundreds of thousands in debt, and concentrated his entire investment in a single asset in a single zip code. David diversified across the 2 most established crypto assets in the world, and while he lost sleep during crashes, he never lost a weekend to a broken pipe. This is where everything separates. By year 20, Alex's property is worth roughly $550,000 to $600,000. His mortgage is either paid off or nearly there. His equity is somewhere between $500,000 and $580,000 depending on appreciation. He's been collecting rent the entire time, but after 20 years of maintenance, repairs, turnover, taxes, insurance, and at least 1 major renovation, his total net profit from cash flow might be $50,000 to $90,000 above what he spent. Maybe more in a hot market, maybe less in a flat one. David's crypto portfolio tells a different story entirely. Bitcoin's historical pattern across 4 major cycles over 20 years, combined with Ethereum's growth as a platform, puts his portfolio at approximately $500,000 to $800,000 depending on market timing. That's with total contributions of $156,000 over 20 years. The other $350,000 to $650,000 is pure compounding through market cycles. no debt, no tenants, no 2 a.m. phone calls about a broken pipe. When you compare net worth, they are in the same ballpark on the low end. But David's high-end scenario significantly outpaces Alex's because of one thing: crypto's asymmetric upside potential. Real estate appreciates at 3 to 5% annually in most markets. Bitcoin has historically averaged significantly higher returns across full cycles, though with dramatically more volatility along the way. But here is the part that changes everything. If David increased his monthly contribution by just $200, bringing it to $600 a month, his 20-year portfolio jumps to approximately $700,000 to $1 million. That's because in crypto, increasing your contribution during bear markets when prices are low has a multiplied effect when the next bull cycle arrives. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and doubling your workload. If I only showed you the downsides of real estate, I'd be doing what every crypto influencer does. Crypto has real risks that people love to gloss over. Volatility is brutal, and unlike stock market crashes that recover in months or a few years, crypto bear markets can last 2 to 3 years. In 2022, Bitcoin dropped from $69,000 to $16,000. Ethereum dropped over 80% from its peak. If David had $200,000 in his portfolio and watched it fall to $60,000 over 18 months, that's not a number on a screen. That's gut-wrenching, and the data is clear. Most retail crypto investors panic sell during crashes and buy back in near the top, locking in losses at the worst possible time. There's no cash flow. Unlike a rental property, crypto doesn't send you a monthly check you can spend. Some platforms offer staking rewards on Ethereum, giving you maybe 3 to 5% annually. On $150,000, that's $375 to $625 a month. Better than nothing, but it comes with smart contract risk and platform risk that real estate simply doesn't have. Regulatory risk is real. Governments around the world are still figuring out how to handle crypto. A major regulatory crackdown, a country banning exchanges, or unfavorable tax treatment could significantly impact prices in ways that real estate would never be affected by. No leverage. David used $60,000 to control $60,000 in assets. Alex used $60,000 to control $300,000 in assets. That 5 to 1 leverage is powerful when property values rise, and it's the main reason real estate creates generational wealth in ways that crypto, despite its higher upside, sometimes cannot match for average investors. And there's no depreciation tax shelter. Real estate investors can deduct the theoretical decline in their building's value from their taxable income, even if the property is actually appreciating. That's a legal tax advantage that crypto investors simply don't have access to. Real estate wins in specific identifiable situations. If you're in a market where the rent-to-price ratio is strong, meaning monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one. If you're willing to treat it as a business, not a side hustle, the returns can exceed crypto, especially with leverage. If you use house hacking, living in one unit and renting the others, you can reduce your own housing costs to near zero while building equity. And if you understand 1031 exchanges, which let you defer capital gains taxes by rolling profits into a new property, you can grow your real estate portfolio in ways crypto investors can't replicate without specific tax strategies. Crypto wins in specific identifiable situations too. If you're an investor who genuinely understands market cycles and can hold through 70 to 80% drawdowns without selling, the long-term returns of Bitcoin and Ethereum have historically been exceptional. If you're starting with a smaller amount of capital where real estate leverage isn't accessible to you, crypto gives you asymmetric upside potential that no other asset class matches. If you value liquidity, the ability to access your money in minutes without agents, closing costs, or waiting periods, crypto wins by a mile. And if you believe that blockchain technology will continue reshaping finance, payments, and the internet over the next 20 years, buying and holding the leading assets in that space is a fundamentally sound long-term thesis. Alex and David both walked away from that decision thinking they were making the smart play. Alex thought real estate was the proven path to wealth. David thought crypto would do the work for him. Neither of them actually sat down and mapped out what this costs in dollars, in time, in stress, and in risk over 10 or 20 years. The real trap isn't real estate and it isn't crypto. The real trap is picking either one based on a YouTube headline, a podcast clip, or something your friend said at a party without ever running the full numbers for your own situation. Real estate gives you leverage, cash flow, tax advantages, and something you can physically touch. Crypto gives you liquidity, asymmetric upside, zero management headaches, and exposure to a technology that could fundamentally change how money works. The smartest investors aren't arguing about which one wins. They're figuring out how to use both. Because when you combine the leverage and cash flow of real estate with the asymmetric growth potential of crypto, that's not just a good portfolio. That's a wealth-building machine that works while you sleep. But for now, the next time someone tells you real estate always wins or crypto always wins, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video changed how you think about about where to put your money, smash that like button. It seriously helps the channel grow. Subscribe for more real finance videos where we run the actual numbers so you don't have to. And drop a comment below. Are you Team Alex, Team David, or are you smart enough to be both? I will read every single comment. See you in the next one.